So we're about to solve examples, and I'm creating the examples on the board. These examples are going to show us how to calculate the cost of equity. These are not all the examples, but this is just the first part. The first example says compute the cost of capital in each case. So there are different scenarios here. Market price per share is 1 naira 50 kobo ex div. Dividend just paid is 0.3 naira, which is expected to remain constant. So what are they asked to calculate? Calculate the cost of capital. Once you see this information, it is expected that you know the formula to use. They won't tell you use dividend valuation model without growth. No. So this should already tell you that you are looking for cost of equity, which is equal to dividend over market value. The dividend is expected to remain constant, so don't involve growth. So this is what you're looking for. They ask yourself, what is the dividend? They told you dividend is 0.30 naira over market price or market value per share, 1 naira 50 kobo. That will give you 20%. So the cost of equity in this case is 20%. Does that make sense? Now this kind of question is not going to come out in ICAN. It's just going to form part of a big question. Maybe in investment appraisal or in corporate valuation. You won't just see a question like this on its own, but you need to understand all of this. So that when you see these lines in question, you know what they're asking you to do. Now the next one is saying market price per share is 2 naira 50 kobo ex div. Yeah, remember that the rule is that this market price must be ex div. You can't be determining cost of equity when the dividend element is included here. So if you say it is home div, you remove the dividend element. Now they said market price per share is 2 naira 5 kobo ex div. Dividend just paid is 0.10 naira, expected to grow annually at 7% rate. So there is growth. So you remember that its cost of equity equals dividend into 1 plus G over market value or market price per share. They can give you in terms of the value, not in per share. You must also know how to use it. Okay. So the dividend here, dividend just paid is 0.10 over market value or market price per share, 2.05. It is ex div. Don't forget to add your 1 plus growth. 7% is 0.07. 0.07. Then you solve. So put that in your calculator and you solve. And that will give you 0.052. That is 5.2%. So that's the cost of equity here. Now, market price per share is 2 naira. Home div, that is dividend, is inside this market value. Dividend about to be paid is 0.16 naira. That's 16 kobo per share. The accounting rate of return on equity is 12.5%. And 20% of earnings are paid out as dividend. With the information, because you already understand those formulas and what they mean, you should already know that you are asked to calculate cost of capital, of course. From which approach? Dividend valuation approach, including growth, right? But here now, you have to determine your growth because they are giving you the variables that you use to determine growth. I remember. So, we are still using this formula that says cost of equity equals dividend into 1 plus G over market value. But now we have to determine growth. Because why did they give us those formulas? Is to determine growth. Now remember that growth is equal to rate of return, okay, or return on investment multiplied by retention rate. This is the Gordon's approach. When you have that, you ask yourself, what is the rate of return? The accounting rate of return on equity is 12.5%. Do that there, 12.5% times, and 20% of earnings are paid out as dividend. Don't forget that this B is retention rate. What is the rate? What is the proportion that you retained? So when they tell you that they pay 20% of something out as dividend, it means 80% was retained, right? So you have 80% or 0.8. Once you multiply this together, you have 12.5% times 0.8. That will give you 10%. So their growth rate, because the rate at which the dividend is growing is 10%. Okay, so you bring that growth of 10% into your formula that says cost of equity equals dividend, where it is 0.16 into 1 plus growth rate 10%, which is 0.1 over, what is the market price per share? 2 naira. But it is cum div. So remove the dividend. You have 2.0 minus 0.16. And this will give you what? You put that in your calculator. Very fast. You guys, let me tell you how you can be fast in solving. It's by solving many questions. Do you understand? So 0.16 times 1.1 equals 0.176 over 2.0 minus 0.16. That will give you 1.84. So 0.176 divided by 1.84, that will give you 0.0956. And then you move it 2 times 1, 2, and that's 9.56%. So this is your cost of equity. I'm trying to be as simple as possible, show you step by step. Normally, I'll just put the answer after putting it, I punch all of this in my calculator and put it. But the answer is 9.56. Now let's go to the last example in this section. Market price per share is 3 naira. Dividend just paid is 0.32. 5 years ago, that has given you indication of the historical method of calculating growth. Why are you telling us about oldest dividend? 5 years ago, the dividend paid was. Does it make sense? So you already know that you are calculating cost of equity and it is involving growth. So you know you are going to use the growth formula. But now, how do you get growth? They've given you an indication that you're going to use the historical method to calculate growth. So just go and work your growth somewhere. Growth equals your newest dividend over your oldest dividend, n, root n, number of years, all minus 1. So growth will be equal to what? N is 5. What's your newest dividend? That is the latest. Just paid 0.32. Oldest, that is the base dividend, 5 years ago, was 0.32 minus 1. Now you solve this. So the growth rate is 9.85%. Then you take the growth rate into the formula. Okay, cost of equity equals dividend. Dividend just paid 0.32 into 1 plus 0.985. Over market value per share. See, market value per share 3 naira. So you solve 0.32 times 0.32 times 1.098. That gives you 0.351 divided by 3.00. So that gives you 11.7%. So your cost of equity is 11.7%. So what this is just showing you is, this one is just dividend valuation model. Now they will not tell you in the exam, use dividend valuation model. They will say that you're the one that will know the model to use. So we'll go to the next question. Time is actually running out. Like, work will soon start in a few minutes. But let's see how much we can cover. You guys, I'm filming every day because if I don't film every morning, I'm not going to do this lecture. And a couple of people have told me, do SFM lecture. I'm like, it's nice. Let's do SFM lecture. Cocoa Melon Limited is a company producing milk, right? Cocoa Melon Limited, and wants to be listed on a stock exchange and be financed entirely by equity. Then they said Cocoa Melon's closest competitor is Mango PLC, a listed company. What does it mean for a company to be listed? They put it's public now. They put their information out there on the Nigerian Stock Exchange, all those companies you see in the newspaper. So they produce milk worldwide. That's Mango PLC. Now they gave you Mango PLC's information. In SFM, that Mango PLC is a proxy company. That is an identical company to the company of concern, which is Cocoa Melon PLC. That one they introduced to you first is the company they are actually considering this question. But they gave you Mango PLC as a proxy company, an identical company. So Mango PLC's details is that market value of debt is 500 million. They said market value of equity is 200 million. Mango Co's geared cost of equity. Geared cost of equity. When you can be remembering M&M approach, where they said that cost of equity of a geared company is greater than cost of equity of an ungeared company. So they're saying Mango PLC's geared cost of equity, that it has debt element in it, obviously, is what? Is estimated at 12%. And its pre-tax cost of debt, that is KD, is estimated at 5%. While the tax rate is 25%. Calculate Cocoa Melon's ungeared cost of equity. The thing is that Cocoa Melon is not listed, so it doesn't have all these details. But you can use a similar company, which is Mango PLC's details, to calculate Cocoa Melon's ungeared KEU, ungeared cost of equity. Does that make sense? So at this point, you should recall the relationship. Recall that relationship. This is what you are looking for. Let me use this red marker. So you recall that formula that shows the relationship between cost of equity ungeared and cost of equity geared. That M&M formula says cost of equity of a geared company equals cost of equity of an ungeared company plus cost of equity of an ungeared company minus cost of debt into value of debt over value of equity into 1 minus T. All the variables, are they not there already? They are there already. Just start putting it in. You already have this. 12%. This is what you're looking for. This is what you're looking for. Let me know this question mark so I'm not confused. You don't have this, but you will get it. KD, cost of debt, 5%. So value of debt times 500 million over value of equity 200 million into 1 minus C. That is was the post-tax cost of debt. No tax, we'll get into all of that. So 1 minus 0.25. Don't put 1 minus 25% because 1 cannot minus 25%. So put it in relative figure because this one means 100% and this one means 25%. So we now start solving. You have 12% equals, first of all, deal with this side. Okay? 12% equals KEU plus KEU minus 5% into 5 divided by 2. Should we do 5 divided by 2 or we should just do 500 over 200 times 1 minus 0.25 is 0.75. Okay? 500 times 0.75, that's 375. Okay? So you have 12%. Don't be writing all of this right as if you are doing secondary school math. Just punch in your calculator and put the answer. Once you are giving them this first breakdown, it wastes time. For me, I'm writing it just for the sake of that maybe they don't even have an idea. So when you do this one, you have divided by 200. You have 1.875. So at this point, you can open brackets. So you have 12% equals KEU plus. You in body mass. You have to sort out multiplication. You see, body mass. You have to do multiplication before you get to addition. So you do all this one on the multiplication side. So you have 1.875 KEU minus 1.75 times 5, 9.375%. Okay, so at this point now, it's easy for you to just collect like terms. What does it mean to collect like terms? Put all identical variables together. So you have 12%, bring this one to this side, plus 9.375% equals this plus this, KEU plus 1.875 KEU. This one already gives you, that is 1 KEU plus 1. That's 2.875 KEU equals 12 plus this one is 21.375%. So to get KEU, divide both sides by whatever is beside KEU, 2.875. This will cancel this, 2.875. Okay, so let's do that. 21.375 divided by 2.875, and that gives you KEU to be 7.34%. So cost of equity of an ungeared company, no debt element here. They already told you that Cocoa Melon is financed by only equity, so obviously no debt element. It is expected that it should be less than the cost of equity of a geared company. And it already proves that M&M theory that says that the cost of equity of a geared company must be greater than cost of equity of an ungeared company. As you can see, this is 12% and it's greater than 7.34%. You guys, do you know I was editing this particular video, this class that you just watched today, only for me to see that one of the clips was missing. So this evening, I just let me quickly redo that example quickly. And let me read it, I'll put it on the screen. It says the current average market return being paid on risky investment is 12%, compared with 5% on treasury bills. Gegeco has a beta of 1.2, that is risk. What is the required return of an equity investor in Gegeco? What is the required return? That's what is the cost of equity. Remember that I said cost of equity or cost of capital is minimum required rate of return, okay? So, very straightforward. Let's solve that. For cost of equity, which is equal to risk-free rate plus the risk into market rate minus risk-free rate. The risk-free rate is what? 5% plus the beta equity is what? 1.2 of Gegeco. Then the market return, say the current average market return being paid on risky investment. Risky investment is 12% minus 5%, which is the risk-free rate. So when you do this, you have 5% plus 1.2 into 12% and 5%, that will give you 7%. 5% plus 1.2, 5% plus this, that will be 5% plus, this time this will give us 8.4%, because 12 times 7 is 84. Then here you have 13.4%, okay? So the cost of equity, which is the minimum required rate of return, has to be 13.4%. And look at it now, it has to be higher than what is obtainable in the market. What is obtainable in the market is 12%, right? This one has to be higher than it. Why? Because that investor in Gegeco is taking a higher risk. Okay? So the second example, the one that even paid me, that got missing, was this. Is this second one? Let's read it there. It says risk-free rate is 5%, market return is 14%. What return should be required for investment whose beta values are 1, 2, 2, and 3, 0.5. Okay? So they gave me 3 scenarios. We are done with this question. B, say if the beta value is what? If the beta value is 1, 2, if the beta value is 2, and 3, if the beta value is 0.5. Okay, they're asking you now what returns should be required. I think that returns required, minimum required rate of return, right? That's they're asking you for cost of equity. And you know that the formula, right, based on the information given, that is capping approach, that will be what? Your risk-free rate plus beta, that is the risk, into market returns minus risk-free rates. Okay? So this risk-free rate is like saying the minimum in the market. That's usually the rate of government treasury bonds, and it's usually low because there's no risk there. So that's what should be the returns if this risk is 1. So you have K is equal to risk rate given as 5% plus 1 into, they give you your market return as what? Check your question, they give it to you as 14%, 5%. In this place, when it is 2, you have KA, what? 5% plus your risk here is 2 into 14% minus 5%. And under the third scenario, let me just move it a little bit here. Under the third scenario, where the risk is equal to 0.5, the cost of equity will be equal to 5% plus 0.5 into 14% minus 5%. So a bit of the explanation that I did here, showing the relationship between risk and return, that the higher the risk, the higher the return. That was why I had to refilm this video. Right, so with these 3 scenarios now, because the risk is the highest here, it is expected that the return should be high here. So you have cost of equity equals 5% plus, when you do this, you have 9%, and that will give you 14%. Here you have cost of equity equals 5% plus, when you do this, this will be 9 times 2, you have 18%, and that will give you 23% as your cost of equity. When you do this, you have cost of equity equals 5% plus, this will give you 4.5%, and you have it to be 9.5%. This is the lowest, because at this place the risk is low. You're not taking any risk, so your returns should be low, right? But at this point it is the highest, because here the risk is the highest. Now see, at this point, cost of equity is equal to the market returns. That is an investor that is taking a risk of 1. He's taking a risk that is equal to what somebody is taking in the market. So his own return is 14%, just like what is obtainable in the market. The moment he decides to take a higher risk, you have a higher return than what is obtainable in the market. So in this example that is illustrating the capping approach to estimating cost of equity was one that got missing. Do you understand? That's why I'm doing it again, and it's just to explain that the cost of equity, which is minimum required rate of return, has a relationship with risk. You understand? So this will be the end of cost of equity. The next class we'll move to cost of debt, which will be tomorrow. I've already filmed it actually because this is days after when I'm editing and now realizing that that clip was missing. Right. So thank you so much for watching, and I'll see you in my next video. Bye.